Welcome to Capitalists versus Consumers, where we break down how money really works and show you how to start building income that works for you. Today we are doing a deep dive into one of the most debated topics in the investing world: day trading versus swing trading. Which one is actually worth pursuing? Which one makes more money? Which one is more realistic for everyday people? We are going to answer all of those questions today with real information, real numbers, and the honest truth that most trading content never tells you. Quick note before we get into it: everything we cover here at Capitalists versus Consumers is for educational purposes only and not financial advice. Trading involves significant risk and is not suitable for all investors. Always do your own research and consult a qualified financial professional before trading. Please hit the like button and subscribe so you never miss a report. Let's get into it. What is day trading? Day trading is the practice of buying and selling financial instruments, stocks, options, futures, currencies, within the same trading day. A day trader opens a position and closes it before the market closes at 4 p.m. Eastern. They never hold a position overnight. The goal of day trading is to profit from small price movements that happen throughout the trading day. A stock might move 1 or 2% in a single session, and a day trader tries to capture that movement, buying when they believe the price will rise and selling when they believe it has peaked, or short selling when they believe it will fall. Day traders typically make multiple trades per day, sometimes dozens. They use technical analysis, reading price charts, volume data, and momentum indicators to make rapid decisions. Speed is everything. A day trader might hold a position for minutes or even seconds before closing it. Day trading is done primarily in stocks, options, futures contracts, and foreign exchange, also known as Forex. What is swing trading? Swing trading is a style of trading where you hold positions for multiple days, weeks, or sometimes months, riding larger price movements called swings. Unlike day traders who close every position before the market closes, swing traders hold overnight and over weekends. They are looking to capture a meaningful portion of a larger price move, not the small intraday fluctuations that day traders target. A swing trader might buy a stock they believe is about to break out of a consolidation pattern and hold it for 2 weeks as it rises, then sell when technical indicators suggest the move is running out of steam. Swing trading requires less time in front of a screen than day trading. A swing trader might spend an hour analyzing charts in the evening and then simply monitor their positions during the day without making constant active decisions. The key differences. Side by side, let's compare the two strategies across the dimensions that matter most. Time commitment. Day trading is essentially a full-time job. Most successful day traders are in front of screens from before the market opens, typically 9 a.m. Eastern, until the close at 4 p.m. Pre-market scanning, real-time decision-making throughout the session, and post-market review require anywhere from 6 to 10 hours per day of active attention. If you have a job day, trading is not compatible with it. Swing trading is far more manageable for people with other commitments. You analyze your positions and scan for setups in the evenings, typically 1 to 2 hours. During the day, you monitor positions, but do not need to make constant active decisions. A swing trader with a full-time job can absolutely pursue this strategy without quitting their day job. Capital requirements. Day trading has a specific regulatory requirement in the United States called the pattern day trader rule. If you execute 4 or more day trades within 5 business days in a margin account, and those trades represent more than 6% of your total trading activity, you are classified as a pattern day trader. Once classified as a pattern day trader, you are required to maintain a minimum account balance of $25,000 at all times. Fall below $25,000 and your day trading is restricted. Swing trading has no such regulatory minimum. You can swing trade with any amount of capital. Many beginners start with $1,000 to $5,000. The smaller account does limit position sizing and the number of trades you can take simultaneously, but there is no regulatory threshold to meet. Risk profile. Day trading risk is concentrated in short-term price movements. Because positions are held for minutes or hours and often use significant leverage, borrowed money that amplifies both gains and losses, the potential for rapid losses is very real. A bad trade can be closed quickly, limiting the damage. But the speed of day trading also means mistakes can happen faster than you can react. Swing trading risk includes overnight and weekend risk. When you hold a position overnight, a news event, an earnings report, or a geopolitical development can cause the stock to gap significantly in either direction when the market reopens, either dramatically in your favor or dramatically against you. Swing traders manage this risk through position sizing, stop-loss orders, and careful selection of when to hold through known risk events like earnings announcements. The honest statistics on day trading. Let's talk about the numbers that most day trading content conveniently leaves out. The research on day trading profitability is sobering. Studies across multiple markets consistently show that the vast majority of day traders lose money over time. A widely cited study of day traders in the Taiwanese market found that over a 15-year period, only approximately 1% of day traders were consistently profitable from year to year. The remaining 99% either lost money or broke even. A Brazilian study of futures day traders found that 97% of traders who persisted for more than 300 days lost money. Only 1.1% earned more than the Brazilian minimum wage from day trading. In the United States, studies of retail day traders consistently find that most underperform a simple buy and hold strategy in an S&P 500 index fund, even before accounting for transaction costs, taxes, and the time invested. Why do most day traders fail? Several reasons. The competition is brutal. When a retail day trader makes a trade, they are on the opposite side of professional traders, hedge funds, and algorithmic systems with significantly faster execution, better technology, more capital, and more sophisticated analysis. The edge required to consistently profit in this environment is extraordinarily difficult to develop and maintain. Transaction costs compound against you. Every trade generates a commission or a spread cost. Day traders making dozens of trades per day accumulate these costs rapidly. Brokerages have made trading appear free, but the spread between the bid and ask price is a real cost on every trade, and it compounds significantly for high-frequency traders. Taxes are punishing for short-term traders. Gains from trades held less than 1 year are taxed as ordinary income, meaning at your full marginal tax rate rather than the lower long-term capital gains rate. A day trader who makes money before taxes may find a significant portion disappears to taxes, particularly in higher income brackets. Psychology works against most traders. Fear and greed are the two most powerful forces in trading, and they work against discipline. A losing trade triggers the fear of further loss, causing traders to hold losers too long hoping for recovery. A winning trade triggers greed, causing traders to stay in too long until the gain evaporates. Consistently executing a disciplined trading plan under real financial pressure is extraordinarily difficult for most people. The honest statistics on swing trading. Swing trading profitability data is less extensively studied than day trading, but the picture is more nuanced. Swing trading has a somewhat better statistical profile than day trading for several reasons. Longer time horizons allow fundamental and technical factors more time to play out. A swing trader who correctly identifies that a stock is undervalued and due for a rebound has days or weeks for that thesis to materialize, rather than minutes. Lower transaction frequency reduces the compounding drag of commissions and spreads. A swing trader making 5 to 10 trades per month accumulates far lower transaction costs than a day trader making 50 trades per day. Overnight risk is a real disadvantage, but it can be managed. Swing traders who are disciplined about position sizing and avoid holding through known high-risk events like earnings announcements can limit the damage from adverse overnight gaps. Many professional traders, including some of the most successful hedge fund managers in history, use swing trading approaches. The strategy is not inherently flawed the way day trading tends to be for retail participants. That said, swing trading is still genuinely difficult. Most retail swing traders also underperform a simple buy and hold index fund strategy over time. The difference is that the losses tend to be less dramatic and the strategy is more compatible with the demands of everyday life. Who day trading is actually for. Day trading is not inherently wrong or impossible. There are people who do it profitably. But understanding who those people are matters. Successful day traders almost universally share several characteristics. They have significant starting capital, typically $50,000 or more, that allows them to absorb early losses during the learning curve without being wiped out. They treat trading as a full-time professional endeavor, not a side activity. They have access to professional-grade tools, Level 2 quotes, direct access routing, fast execution. They have spent years developing their edge through extensive practice, study, and paper trading before risking significant capital. And they have the psychological constitution to take losses without emotional disruption, which is far rarer than most people expect. If you are considering day trading, honestly ask yourself, do I have $25,000 or more to meet the pattern day trader requirement with additional capital to absorb losses? Can I commit to this full-time? Do I have the tools and education? Most people who answer these questions honestly realize day trading is not the right path for them right now. Who swing trading is actually for? Swing trading is more accessible to everyday people for several reasons. No minimum capital requirement allows you to start smaller and learn with less money at risk. The ability to hold positions while working a regular job means you do not have to quit your day job to pursue it. The slower pace gives you more time to make decisions, reducing the psychological pressure that destroys most day traders. Swing trading tends to work better for people who are patient by nature, willing to wait for the right setup rather than constantly feeling the need to be in a trade. It works better for people who can accept overnight risk and manage it through position sizing and stop losses. And it works better for people who are willing to invest significant time in learning technical analysis, chart reading, and risk management before committing serious capital. The most important question, versus just buying index funds, here is the question that most trading content never asks, and it is the most important one. Why trade at all instead of simply buying and holding a low-cost S&AMP? P500 Index Fund? The S&AMP P500 has delivered average annual returns of approximately 10% over its entire history. It requires no skill, no screen time, no analysis, and no active management. You simply invest and let compound interest work over time. Both day trading and swing trading require significant time, skill, capital, and psychological discipline to outperform that simple benchmark. And the evidence consistently shows that most active traders, retail and professional alike, fail to do so consistently over time. This does not mean trading is wrong for everyone. Some people find genuine intellectual satisfaction in the craft of trading. Some people develop real edges over time through extensive study and practice. And the skills learned through trading, reading charts, understanding market structure, risk management, have genuine value beyond just the profit and loss statement. But for most people who are asking whether they should day trade or swing trade, the honest answer might be, consider whether either one is better than simply building a diversified long-term investment portfolio and letting it compound while you focus on building income through your career or business. If you are going to try trading, do these things first. If after understanding all of this you still want to pursue trading, here is how to approach it responsibly. Start with paper trading. Every major brokerage offers simulated trading with virtual money. Paper trade for at least 3 to 6 months before risking real capital. This lets you test your strategy, build discipline, and experience the emotional reality of trading without financial consequences. Start with swing trading, not day trading. The lower time commitment, lower capital requirements, and slower pace make swing trading a more manageable starting point. Master the basics of chart reading, position sizing, and risk management at a small scale before considering day trading. Use strict risk management from day one. Never risk more than 1 to 2% of your total trading capital on any single trade. This means if you have a $5,000 account, your maximum loss per trade should be $50 to $100. This sounds conservative. It is conservative by design. Conservative risk management is what allows you to survive the learning curve long enough to develop real skill. Study relentlessly before trading with real money. Read books on technical analysis and trading psychology. Study charts every day for patterns and setups. Understand the indicators you are using and why they work. The best traders are students of the market, not gamblers. Keep a trading journal. Record every trade. The setup, the entry, the exit, the result, and your emotional state during the trade. Review it regularly. The patterns in your journal will tell you more about your trading than any indicator or strategy. Treat early losses as tuition. The learning curve in trading is expensive for almost everyone. Approach early losses as the cost of education rather than failures, and set a maximum amount you are willing to lose during the learning phase before stopping to reassess. The verdict. Which one is actually worth it? If you are going to pursue active trading, swing trading is the more realistic and accessible option for most people. It is compatible with a regular job, requires less capital to start, and gives you more time to make thoughtful decisions. Day trading, as practiced by retail traders, statistically produces losses for the overwhelming majority of participants. It requires full-time commitment, significant capital, professional-grade tools, and an edge that takes years to develop. For most everyday people, it is not worth the time, money, and stress involved. But the honest answer for most people watching this is that neither day trading nor swing trading is likely to outperform a simple buy and hold strategy in a low-cost index fund over time. Building wealth through consistent long-term investing while growing your income and reducing your expenses is a less exciting path, but it is the one that actually works for most people. If trading interests you, pursue it, but pursue it with open eyes, realistic expectations, and strict risk management. And never trade money you cannot afford to lose. That is a wrap on today's breakdown here at Capitalists versus Consumers. If this gave you a clear and honest picture of both strategies, please hit the like button. It helps more people find this content. Subscribe and turn on notifications so you never miss our weekly breakdown every Friday after the close and our daily after the bell market report every trading day. We will see you in the next one. Resources mentioned in this video: How to Day Trade for a Living by Andrew Aziz, Swing Trading for Dummies by Omar Basal, Trading in the Zone by Mark Douglas. This video contains affiliate links. I may earn a small commission at no extra cost to you.